Hello and welcome to the Quorum Forum. This will be our first broadcast of the 2025 year, and today we have a special guest with us, Mary Ann Bartels, Chief Investment Officer with Sanctuary Wealth. We've known Mary Ann for many years. She's one of the most prominent and respected analysts and economists in the country. We worked with her at Merrill for many, many years, and her insight and opinion is something that we really hold dear in our practice. And we wanted to spend some time with her today to talk about the outlook for 2025, what to think about trends in the market, and where we're going to go from here. Mary Ann, welcome and Happy New Year to you.
Thank you, Mike. Thank you for having me, and a very Happy New Year to you and to your clients.
Thank you. Well, let's go ahead and get started. We're going to try to cover a couple different areas that I think our clients might be thinking about. One of them is we just came off of 2 spectacular years in the stock market. A lot of that was driven by a lot of excitement about AI and the companies that are working in that space and benefiting from it. Usually, when you have a couple really strong years, you have a tendency to start running, more and more risk at some time, having a correction and seeing that. How do you feel about the market right here at this point? Are we overdue for a correction, or is it something where you feel like we're just going to continue to move forward?
Well, Mike, you're correct. It's very unusual to have 2 years where the market is up over 20%, and I'm actually forecasting that we can have a third year of markets being up 20%. The last time that happened was in the late 1990s. AI really started to affect the market behavior in a positive way last year, and I expect that to continue. It's one of the fastest adopted pieces of technology. As we develop newer and newer pieces of technology, we're adopting it faster and faster. And it's not just about AI. The U.S. economy is growing. We are the fastest growing developed market in the world. And I am a huge fan of technology. But if you want to invest in technology, particularly AI, blockchain, robotics, you have to come to the United States. The companies are here. They're in the public markets, they're in the private markets. There's a select few companies overseas, but really not enough to really even have a diversified portfolio. In my year ahead report, I said because of all of this, we were going to attract capital, and we are. You're starting to see money come to the United States, and also because we're getting a change in administration. I am so bullish. I'm almost like giddy. Now, that does not mean that we can't have corrections or pullbacks. Last year, I called the market the year of the bucking bull. That bucking bull may continue, but the year ahead title I used this year was All That's New is Old. And I went back and I compared our markets not only to the 1990s, introduced computers and networking computers and the internet into the business world that created productivity, but we can also go back to the 1920s. Believe it or not, going from horse and buggy to a car was technology. Electricity was technology. The railroad was technology. We've been through this before. And we can have extraordinary performance in the economy that translates into great gains in earnings, great productivity that really sustains what we call a secular bull market. So I'm pretty optimistic. We may buck here every now and then. We can talk about the risks of what will cause that. But overall, clients should stay invested. I'm very bullish.
And when you say buck, it's well, knowing you, I know what you mean by that is we're going to have hiccups once in a while and have little corrections in the market, which are very healthy and very normal part of the process. And a lot of clients, when we speak to them, do have some concerns about, what the next downturn is going to be. And we have to remind them that those are usually the opportunities to where we can introduce more capital in the market, reposition our portfolios and whatnot. And regardless, in our in our experience and our history, we always tend to find the market ends up going back to new highs at some point down the road, and staying in the long view is really where the payoff is. And to go a comment or step further with what you said, it does appear that we're in a golden age in the United States. I believe it's 85% or more of all of the AI companies are actually here, and it's not just that high percentage. It's all the other companies that are helping build that. The picks and shovels that I would think of if we were to compare it to like the gold rush. The gold miners that were discovering gold, some made money, some didn't, but all the people that supplied them with the materials to dig the gold out of the ground are the ones that really made a lot of money during that time. So when I look at the Magnificent Seven and the promise that they have, going forward, you could tell that it's just going to be, a real game changer and a generational amount of wealth and growth and technological gains are going to come from them. I don't think there's any doubt about that. But as far as what impacts they have on the overall market, the Magnificent Seven, I think, makes up about 40% of the S&P 500 as far as the weight. So if they're volatile, the market's going to be volatile. Is there any thought of the other sectors of the market that may not be as richly valued and but will benefit from not just the efficiency of AI or being the companies that are selling the picks and shovels to the companies that are developing AI, where the thought of perhaps having more of an equal cap weighted S&P 500 exposure versus our traditional S&P 500, which is all cap weighted. If I said that without making it too confusing, I'm sure that you can straighten out what I said.
No. You said it correctly. You do have concentration risk. You're talking about concentration risk in the market. And many people are concerned because you have a few companies that are driving performance, that means markets can't continue on their path. I disagree with that. The whole structure of the market has changed drastically over the past 40 years. There was a time where we had over 5,000 listed companies on the New York Stock Exchange. That's down to, maybe 3,500. More and more companies are choosing to stay in the private market and not go public. Now, we're hoping that we'll see some more companies become public this year, but we've really seen the supply of stock contract greatly. There really is no correlation over time to a concentrated market. We do go back and look at the Nifty 50. That's the market period where you had some concentration. And it was called the Nifty 50, but it was really 100 companies. It wasn't even 50. This is even more concentrated than then. So now you have to really look at the fundamentals. What kind of companies are these? And when you really break down the Magnificent Seven, and there's a few others than just 7 stocks, I'd like to call it tech and tech related. They're great companies, great balance sheet, great cash flow, many of them sitting on piles and piles of cash. They're fundamentally sound companies. There are concerns about valuation, but the market is willing to pay up for growth. And I don't have a problem with that, particularly now that we've had 100 basis points in interest rates cut by the Federal Reserve. When you cut interest rates, you can actually expand your PE multiple. I am sympathetic to the argument that the valuation of the market is expensive. If you go back to the 1900s, our market is expensive. But my argument has been when you're in a secular bull market, which I believe we're in, we started it in 2013. I think the secular trend ends at the end of the decade. PE multiples expand. I think this movement in artificial intelligence, blockchain, robotics, building out infrastructure, will over time expand our PE multiple. And those companies are the leadership within the marketplace. And I don't see that broken. And so because of that, I even though you have this concentration, I still believe markets will go significantly higher. So I'm in the camp that market cap or mega cap stocks will continue to have the best performance. And when we look at growth versus value, and tech really falls into the camp of growth, that it will maintain its leadership.
Well, it's an interesting time as well, where we're in a country that has a large amount of national debt, right? And everyone is very, very hyper-focused on what the Federal Reserve does, at least in the public view, in the news cycle. Well, we have a situation where we have somewhat of a generation of people that got used to interest rates being 0 to 2%, and they think that's normal. I started out in my career trading bonds. That's not normal. That's not where rates are usually. And markets, historically have done very well in times of inflated interest rates. I remember when I was starting out, 7, 8, 9% on muni bonds. And the stock market still did very fine during that period of time. It really comes down to what earnings growth is and the fundamentals, as you say. So in watching what the Federal Reserve has done, we've come down we have come down 1% from where they were originally on their target. But something that has surprised a lot of people along the way is longer term bonds, the 10-year and 30-year bonds, have actually crept up in yield during that point. And the fear, there's always some reason to be afraid, right? And the fear that I read about and hear is that, it's a harbinger of doom, and there's going to be inflation in the future, and this next administration is going to come in and create a lot of inflation. And it's surprising to me, because the last several years we've had the highest inflation since the 1970s. The markets did remarkably well, and people have already forgotten that. So if there's a reason for inflation to happen in the future, it's not a bad thing if you have expanding GDP, expanding earnings, the economy is thriving. And I think that the U.S. is set up, it appears this way, that we're set up again for a golden age, where you're going to see a lot of growth. And we actually do need to have that in order to deal with the national debt that we have. Quit borrowing, expand our GDP, and at some point our GDP becomes large enough to where the amount of debt that we have is not as significant if we can grow it up beyond that. So any comments you would have on what we see going on with the yield curve? Because if the Fed continues to lower a little bit here, you're going to have yields between 3.5%, 4%, which probably be ideal. And I know that's where your forecast is. And if we keep 10-year bonds at 4.5 and higher, that actually the picture of that on a chart is a very healthy yield curve with a nice steepening yield going out in the future. That's if you take economics, that's what they teach you as the optimal yield curve. Yep, people are kind of freaking out about this, that rates are going up on the long end while short-term rates are going down. And I look at it and think, well, you had an inverted yield curve for 2 years and you weren't freaking out about it, because that's showing a really negative outcome. Probably rolled on too long, and you can give better insight on that. But what do you think about that?
So the markets move based on the delta change in information. And I think, now this is my opinion, I think you're seeing the 10-year back up currently for 2 reasons. The economy is growing a lot faster than expected. Mm-hmm. I don't think that's a bad reason for rates to go up. The other one is a little bit stickier, and that is inflation. So it's all based on inflation expectation. Inflation has not come down to the Fed's target of 2%. And we've seen recent inflation data be they call it sticky. It's just not coming down. And the bond market just doesn't like that, because the expectation was for it to come down. I don't think the level of inflation is bad. Again, it's based on expectations. So that's where I'll get a little fancy. That's where I go to the break-even market. You'll know what the break-even market is. Anybody that's in the bond market knows that. Average person probably has no idea what a break-even is. But I look at break-evens which price in the inflation expectations in the fixed income market. And the Fed watches this very closely. And they look at the 5-year and the 10-year. Not pricing in any future inflation. If that was going up, I'd be a little bit more concerned. But let's say that, that the data this week, and we're getting lots of data this week, we see the 10-year right now up around just above 4.6. That's because IMS services index came out, but what spooked, I think, the market was the price component was up a lot. Again, that inflation tag. We could see the 10-year back up close to 5. Now, 5 is normal relative to history. That is a very normal interest rate, and our economy and companies can operate in that kind of environment, but it'll spook the markets and you'll get a market correction, anywhere between 5 and 10%. But I don't think it derails the bull market. To talk about the deficit, we've been debating deficits since the 1980s. I remember when I was back in college, professors debating having a deficit, whether or not it was good or bad for the country. And having very large deficits are not good. Having a lot of debt in general is not good. But what's most important is that you can pay your debts, or the borrower, the people buying our debt, believe that we will pay it off. As long as they believe we'll pay it off, we have no problem funding the deficit. And I see no problem with all this money being attracted to the United States. I see no problem, because go around the world. Where else would you go? Europe is not doing well. China is not doing well.
We're not going to buy Russia bonds.
Don't want to go to emerging markets. I always say we're the prettiest house on the ugliest block. I mean, we're doing very, very well. And I remind people, artificial intelligence enhances productivity. I think we are already seeing productivity enhancements. I don't even think analysts know yet how to even price that in. And I'm not picking on analysts. I don't think we really know. But I do believe productivity will increase. That over time lowers inflation, but it also helps your economic growth. So when Clinton was in office, no one was expecting the deficit to go to a surplus. This is the 1990s, right? The innovation of computers and networking computers and the internet, we actually went to a surplus. Now our debt levels are higher, but I think part of how we can offset this deficit is by growing our economy over time. Right. The other thing is that got some attention that I think you're going to be hearing more about is the US building a reserve in Bitcoin. And I'm sure a lot of your Californian clients are very familiar with this. Now, this is my personal opinion. Should the US government start building a reserve in Bitcoin? There are people postulating that it could offset part of the deficit. And I would be in agreement with that. Because my bias over time is that Bitcoin will go up over time, right? It's a very, very volatile asset. It's probably the most volatile asset I've ever encountered it in my career. But I do believe over time, Bitcoin will go up, and that could be another offset if we were to develop a reserve currency in Bitcoin to offset the deficit. So I'm not as concerned about the deficit as many people are. But can the bond market get spooked from time to time and yields spike up and get near 5%? They can. But again, I don't think it derails the growth in the economy, and I don't think it derails the secular bull market in equities. But you're going to still hear a lot of people talk about it.
Yeah, and agreed. And I do think that having a healthy yield curve is what the end result is going to be from what we're seeing in the current trend. And eventually, I think we'll all wake up to that and realize it's probably best for everybody. So what else do you see coming down the horizon now that we've seen some of the trajectory for AI and automation and robotics and all these things? Of what other industries are going to get a lift from this moving forward that are probably being ignored now?
One of the sectors that I've really liked, it's worked and then kind of slid back a little bit, are the industrials. A lot of the industrial companies, those are the companies that supply in part of the infrastructure that's needed to build things. Because one of the things that we're going to need is more electricity too, to power all of our needs in terms of the electricity demand, for AI, for the blockchain, the mining, and everything. So I do still favor the industrials that have recently pulled back. If I look at sectors like healthcare, these are considered defensive parts of the market. Healthcare actually looks like it's in intensive care. It really is not performing well at all. The consumer staples, which are the companies that provide the products that you have to buy no matter what the economy is like, not doing well at all. It's all about what we call cyclicals. You want consumer discretionary is a sector. Now, there's a lot going on in consumer discretionary. You've got retail, you got home buildings, you got cruise lines, autos. So there's a lot in consumer discretionary, but the consumer is still spending. The consumer still wants to have experiences, and that's really benefiting consumer discretionary. Services, communication services, you've got Google in there, you've got Meta in there. Believe it or not, that was the best performing sector last year. And that's why I call it tech related, because you have related tech companies in consumer discretionary, because you've got Amazon in there and you've got Tesla in there. So I like, I like your basic tech. I like your communication services. I like consumer discretionary. The value part of the market where, like things like utilities and energy, I don't think they're going to do great. Let's look at financials. Financials are actually doing well. And we're going to get banks reporting next week. I think the banks look really good, especially now that we have that steeple yield curve. But the pocket I even like more than banks that you don't hear many people talk about, you may hear about stocks, but not the industry group, is called capital markets. Everything that's related to the stock market. If we're in a bull market, that industry should be doing all, and it really is. So I like, and that's everything from market exchanges to, believe it or not, private companies that have gone public are in there. So that's a part of the market. So financials in general would be another pocket of the market that I like.
Well, definitely the new administration is looking very hard at regulations and changing those in a way where it would free that up for capital markets. And if some of the things we're talking about come to fruition, the drawback that's gone on over the last several years, which is the real cause of why we only have 3,500 or so stocks listed versus greater than 5,000 in the past, is companies don't want to go public anymore. It's too onerous. There's too many regulations. It's too costly. It's difficult to do. And the private markets have been able to provide a high enough multiple to justify companies staying private. We think that may change quite a bit as a result of this, from what you're saying. They're also favorable of some of the crypto markets and support that, so that would probably drive that as well. Obviously, with the industrials, if we look back on when Trump was in power last time, he pushed the America First agenda, which tried to bring everything back. And you hear a lot about the new administration's desire to have tariffs and to create a more fair playing field. But could that be more of a problem as well and be detrimental to the U.S.? Well, what I remember happening, 4 years ago is 8 years ago, 4 years ago. During that time, a lot of companies started reshoring back to the U.S. You're bringing that, you're bringing, manufacturing and industrials, demand back to the U.S. I believe that trend may continue. So if I'm going to wave a tariff in front of you saying, hey, if you want to sell your cars here in the United States, you can pay this tariff, or you can build all your cars in the U.S. that you sell here. What do you want to do? I think it's a negotiation tactic of waving the tariffs out there. I don't think it's going to be an all or nothing kind of deal, which is just going to continue to drive more and more manufacturing and it's going to drive our GDP a lot more over the next couple decades. Would you agree with that? Or
I do. In fact, I went back to see where CPI is, the measure of inflation, when Trump left office. It was at 1.4%. The tariffs that he implemented did not create any inflation. in a broad economic sense. And a lot of that, though, when I looked into it, had to do with the tariffs on China and China not passing through the tariffs. So we hear a lot of people say tariffs are inflationary. You really have to look at what the Trump administration actually implements. And I would agree with you. Part of it is definitely a negotiation tactic, and it depends on what they put the tariff on. You may have pricing pressure on a particular item. I'll give you an example that's going to be a little weird. Washing machines. There was tariffs on washing machines, and guess what? Washing machine prices went up. And then they made more washing machines, and then washing machine prices went down.
Right.
Right. So you can't just panic that everybody's saying, oh, he's going to use tariffs, broad-based tariffs, going to be inflation. That's not necessarily the case. And it did not create inflation in his last administration. And I also want to comment on M&A. The Trump administration is expected to have more of a deregulated type of environment. And remember when Reagan came in, there was a lot, and Thatcher was in power. There was a lot of deregulation. It was one of the best times to be invested in the market. So yes, I think having a more friendly environment and able to get business done, that's kind of how I look at it, is very bullish for the markets. And we are anticipating if that environment does occur, you will see more IPOs come to the market as well.
Yeah, I think a lot of our friends in Silicon Valley and our clients in California, some of them have been waiting for a time like this to come back. And, we hope for them and for, our entire community and for the whole country that the capital markets open back up, and it could be a really good time. So Mary Ann, one of the areas of investment that we usually allocate to is international. So we go outside of the United States, usually for a nominal amount of our clients' money. Some years were as low as 5%. We went to pretty much close to none for many over the last couple of years, to as high as say 20% or so in allocation. And that's traditionally a really good thing to do. It's just further diversification. It gives representation of portfolio of a global perspective or whatnot, but it really hasn't been a good return for the last several years. There's some interesting things about the developed markets outside the United States from a value standpoint. Dividends are plus or minus 4% in some of these areas, and there's super high quality companies around the world that we want to expose our clients to, but it just hasn't been favorable, not just because the dollar's been so strong, but just the growth hasn't been there. Do you think that's going to change anywhere down the road? And is there benefits, whether it's coming from AI or different trends that you see where the political structures are changing or the business structure is changing around the globe, where you think there might be opportunity again on the international side?
Not yet. Not yet. There's two countries I like, but in general, overall, I think international performance is going to continue to lag. And a lot of that, there's a lot of political turmoil, a lot of economic turmoil. And then you have the dollar, and I'm very bullish the dollar. Again, we are the innovation of technology. And that's just going to continue to attract capital here, driving the dollar higher. Our interest rates are significantly higher than most countries. I should say most developed countries. That will attract capital here. We are considered a safe haven, right? At the end of the day, we pick on ourselves a lot, but the rest of the world wants to be invested in the US. And here's the thing, if you're a global portfolio manager, the US is a big part of your benchmark. And if you want to be invested in tech and tech related, you have to come here. You don't have a lot of options. So I think the bias will remain towards the US. But two countries, I think India continues to look interesting, and Japan. There's a huge revival happening in Japan in terms of corporate governance, in terms of I think they're going to become a manufacturing hub, but you're going to have to be careful of the currency exchange, because I do see the yen depreciating. And so there are ways to hedge a Japanese exposure, and I think that would be prudent. I don't think there's a way to really hedge for India. I don't think there's an instrument for that. But in general, I still think the U.S. is going to continue to have the lead performance.
Well, it's with there's a debate right now in Washington on the H-1B visa limits and everything else, so that might open up to be even higher. And I think what you'll probably see is an importation of even more talent from around the world coming here, and the result may end up being we've imported a lot of this additional growth and talent along with it, again to our benefit.
Yeah, I mean,
that's interesting.
We have semiconductor plants that are being built here. We don't have enough of our own engineers to actually go in and work there. So that's where I think part of the H-1B visa comes in. No, I mean, we're going to become part of a manufacturing hub for tech. At least under the Trump administration, based on the comments that President-elect Trump has made. And I can see it in the behavior of the markets. I can see it in the behavior of the stocks. And again, the part of the headwinds, we have two headwinds: valuations and the 10-year Treasury yield. So that's where you can get some pullbacks. But at the end of the day, I don't think a 5% yield will permanently derail the bull market. And I do think PE multiples will wind up expanding. I think the earnings coming out of these companies are going to be much higher than what analysts are expecting. And again, I think it's very hard for analysts to figure out what that new earnings number is with new technology. We haven't been down that road. If the company doesn't give them good guidance, they're not going to know. And let me give you a great example. And I'm not picking on anybody. These are just plain observations. When NVIDIA announced its blowout quarter 3 quarters ago, I mean, significantly above street estimates. Where were those analysts? Come on, you have the best analysts on Wall Street. You have everybody covering it. They couldn't figure out that NVIDIA was going to have blowout earnings. That's this is all new. So and again, we might have pockets where we have a bad quarter and then we have great quarters, but I think some of the new stuff that's coming out is very exciting. I think it's going to be a great year for innovation. Again, I get giddy based on what I'm seeing. And why do I see? I always ask myself, why do I see this and other people don't see it? Well, number one, not many people are in the markets doing this 40+ years. Most of us are retired and don't want to do this anymore. That's number one. Number two, my aunt educated me, Aunt Bernadette, and she told me I had to look at 3 different phases: very long-term, intermediate, and short-term. And I feel many times that we're looking too short-term and we're not taking a bigger, broader look at what's happening. So when I take a bigger, broader look, I'm going, this is going to go on till the end of the decade. Now, we may have another bear market. I don't think it's this year, maybe next year. Bear markets meaning the S&P goes down 20 to 30%, but comes back and recovers and goes on to all-time new highs. So it's a very painful period, but we recover. When Trump was in office, he had a bear market in 2018, right? He came in 2017. We actually had a bear market in 18. So, bear markets are part of the investment process. That's where clients need to be patient. But I think this whole tech-related AI, blockchain, crypto, robotics will play out to the end of the decade, 2029, 2030. And then things may change. That's where I see a pivotal change, if I'm correct on the performance of the markets, because my long-term forecast on the S&P is somewhere between 10,000 and 13,000.
Wow, that's significant.
Which is quite significant from where we are today. But I do think that those are very achievable. And my forecasts this year are 7,200 to 7,400. So that's another 20% gain. And again, the last time we saw that in recent history, we're back in the 1980s.
Fantastic. Well, let's hope we all get to see that come to fruition. I actually believe that if some of the things that this country's, what we've been moving toward for the last decade, continue to come to fruition, I think we'll see that. And that's basically a doubling of where the markets are at some point in the future, which would be fantastic. Mary Ann,
can I say, which gets to your point? It's the golden age of investing. So when we did our annual conference last year, my theme, as you know, was the golden age of investing. And that was back before the election with Trump. I think that was towards the end of October. And then Trump comes out and says the golden age of America. And I really think that there's a lot to that. I really do believe we're in a very golden period. Now, we won't absolutely know that until we do a look back. But I think that this is a spectacular time in our economy, in our development of technology, and where that's going to lead us over the next 4 to 5 years.
Right. And it's not a political statement. It's just more of where the economy is going, this innovation, all these amazing things that are going to improve the quality of all of our lives. Well, it is the new year, Mary Ann, and we all have resolutions. Is there a bucket list resolution that you have for this year that you can share with me?
You want to know? I was thinking about that. I'm not good with New Year's resolutions because I'm not good at following through on them. But
Right.
where I'm terrible personally is following up. People will ask me like, "Oh, let's go to dinner, let's do that." And I just get scatterbrained and I'm like, "I'm going to make a commitment to stay connected to family and friends." That's my commitment, is that I will try to stay connected to family and friends.
Well, it's one of the best ways to stay relevant and stay young, right?
Oh, definitely,
Fantastic.
especially when I
Yeah.
have a 3-year-old that lives upstairs. She keeps me on my toes.
Wow. Okay. Well, you're busy enough, and I didn't realize you had that going on too. I hadn't seen you in a while, but well, Mariann, really enjoy your friendship. Your insight has been incredible. I know you've received a lot of accolades, whether it was just from Bloomberg or Barron's or all the other people that watch out there. That you've been about the most spot on of anyone in the world on your market calls over the last couple of years. So I commend you for that. I really appreciate the fact that we have you as a resource and access to your thought, and have you as a friend as well. So I
Thank you.
really appreciate your time today. And for everyone else listening, thank you for tuning in to the Quorum Forum. Have a wonderful new year, and we look forward to speaking with you soon. God bless.